Hi, my name is Jamie Wright. I'm a portfolio manager and the research director for First Merchants Private Wealth Advisors. Thank you for taking a few minutes to listen to our webcast. We hope to provide insight into our thoughts regarding the economy and capital markets as well as current events. We know that investors have many questions and a lot of uncertainty in regard to the economy and markets, and ultimately knowing if their investment portfolios will be okay. Recent economic data reflects exactly what one should expect given current circumstances. The positive momentum we enjoyed for several years has greatly slowed. In short, while we expect this to last for the near term, a good steward is always making the attempt to look past what is currently known and plan for what comes next. And while our current situation appears somewhat bleak, we are confident this virus will be behind us at some point and we can begin a resumption of living our lives largely as we see fit. That's the scenario we're planning for. Today we'd like to share a few investment concepts that seem pertinent to our current situation, especially as regards investing in equities. The first chart reflects one-year returns for the Standard & Poor's 500 from 1950 through March of 2020. The portfolio that is 100% invested in equity at the top enjoyed an average annual return of 12.4%, with a worst year of negative 43.3% as represented by the red bar to the left, and a best year of 61.2% as represented by the blue bar to the right. The difference between the two extremes can be thought of as price volatility. Please also note that as safer investments are added to the portfolio, here represented by intermediate-term treasury bonds, the distance between the left of the red bar and the right of the blue bar is diminished at only a slight give-up of average annual return. Page 2 reflects the same data but for rolling 5-year periods. For instance, 1950 through 1954, 1951 through 1955, etc. Please note something important. As the time horizon increases, here from 1 year to 5 years, price volatility is diminished, again as represented by the distance between the left of the red bar and the right of the blue bar. As well, note how the representation is skewed to the right towards positive returns. The average annual return is slightly lower at 11.1%, but the 1.3% difference from the 1-year horizon and the 5-year horizon is made up for by the decrease in average price volatility. Again, as the investor adds relatively safer investments, price volatility decreases. We'd like to make these points. First, the equity risk premium is the extra return an equity investor should expect over and above a safe investment, say a treasury bill, for realizing more risk or price volatility. But one can also add relatively safer investments to their portfolio which will serve to decrease price volatility. This is why an appropriate asset allocation is crucial to your expected return as well as mental well-being in times like these. Second, price volatility can also provide opportunity. In powerful bull markets, it can provide the opportunity to take profits and reposition your portfolio. In a bear market, to make adjustments in a portfolio because investment assets have gone on sale. The next chart makes the same case, but in a more visually compelling way. The top chart is a distribution of one-year returns for the S&P 500, again since 1950. Returns are plotted such that positive returns are to the right, negative returns to the left. Please note that even as the returns appear evenly distributed, meaning the graph is fairly symmetric from left to right, the majority of the returns are positive, as indicated by the data at the bottom. The distance between the left side, or negative returns, and the right side can be thought of as the same as we saw in charts 1 and 2. The far left side of the graph, representing large losses, is called tail risk, a term you may have heard of in 2008 and certainly lately. Though the occurrence of large losses, represented by the left tail, are few and far between, they are the large losses that can make you re-examine your appetite for risk, at least as represented by price volatility. The distribution of returns in the middle is the same data, but now for rolling 5-year periods. Note how much tighter the distribution is, or the distance between the left and right, which again indicates the reduction of risk or price volatility as one's time horizon expands. Please also note two other things. The median return is only reduced by 1.9 percentage points, while a positive is that risk, or price variability, is greatly reduced. And as above, the majority of returns are positive. The 10-year distribution only enhances our viewpoint. In summary, we'd like to reinforce a few points. An appropriate asset allocation should reflect your current and expected circumstances, as well as an honest assessment of your tolerance for risk. That time is at once the critical factor in putting the odds of success in your favor, as well as the basic measuring stick for risk tolerance and asset allocation, and that the periodic rebalancing of a portfolio is a crucial tool in helping to mitigate risk. Thank you for your time today. We hope we conveyed that we are looking past what we already know to the next steps, which is an economic recovery and a clearer path forward. Please stay safe and healthy, and we look forward to our next communication with you.